Hi guys, welcome to the first lecture of implementing market structure. And in these set of videos, we are going to actually dive into different strategies and different ways you'll be able to develop as a trader. So we're going to go through how you should adapt yourself to the markets and what time frames you should trade based on if you still work or whether you are trading full time. We're also going to outline the possible strategies based on the temporal disposition and different entries. We can look at different stop, different targets that you'll be able to implement yourself and see what suits you essentially. I'm then going to introduce you to one of our most profitable patterns, which is called the OTE pattern, and it's actually an ICT concept. ICT is a well-known trader in the community, and we've kind of took that pattern on and put our own twists onto it as well. And finally, we're going to talk about how you should have a daily routine and how your daily routine is going to really define you and define who you are as a trader. So moving in onto the charts, I'm just going to say from the start, you need to figure out what timeframes are going to suit you when you are trading. So I obviously don't know what all of you guys are going to be doing, and I don't know if you are going to trade full time. Well, I'll find this out when we have our first one-to-one, but you might have different things you have to do every day at specific times, or you might actually work full time, so you're not going to have the time to spend looking at charts every day. So it will be down to you as to figure out when are you free. Will you work fixed hours in the day, or will you have time to spend at your desk, whether that's on your lunch break, whether that's in the morning, at night? You will have a screen in front of you where you are able to look at the chart. So you will really need to match your personality to the trading strategy rather than vice versa. There's no point you just copying our trades, let's say, because I know Kieran and myself will trade on multi-different time frames. We'll trade at M1, M5, M15, and if you're not there at your screen, you can't watch these time frames. You can't just follow our trades because, as we said at the start, we are not a signals group. There's a strong emphasis that you don't copy our trades on a daily basis because you just won't learn anything from it. You need that accountability from the start. And when you are just sitting there copying our trades, yeah, you might hit a few winners, you might hit a few losers with us, but there is just no accountability. There is a serious loss of accountability in there where you can't be accountable for your own results, and you just go through this cycle where you don't progress at all. And that's literally what we don't want. We'd rather you go out there, implement a strategy, maybe you have a few losers in a row, but we can tweak a few things and you start to become profitable, because that's the real step, and that's the way it should go. So to start off with, as I said in the beginning, it will be down to you to figure out what timeframes you're able to observe. As a general rule, and as general advice, I would say if you are working during high liquid hours, then you won't be able to trade on anything below the 1 hour time frame, most likely. And that means if you are at a 9 to 5 job and you literally don't have time to look at the charts at all during the day, if you do have time to look at the charts, maybe on your lunch break, maybe when you are not busy because you have a desktop so you can flick to the charts, then yes, potentially you could trade the half an hour chart as well. But anything below the half an hour time frames is not possible during those high liquid hours. And what I mean by those high liquid hours is essentially the London Open and the New York Open. So the London Open the market starts to become liquid from around 7 a.m. So if I just scroll into here, it's 8 a.m. So you can see from 7 a.m. you can see Asia is trading within this consolidation here where the market doesn't really move. So from the high to the low, there's only about 27 pips. And then as I was saying, the Asian session was only 27 pips here. But then as soon as the London session opened and we have that liquidity start to come into the market, you can see from the low here towards when the London session closes, before 5 p.m, you can see there's a move around 120 pips. It's a massive move in the market because that's when the liquidity picks up. That's when there's most active trading hours. That's where these big institutions, these big banks, these big hedge funds are out there trading the market. So that's what we mean by these high liquid hours. And you can see that's the situation every day. Like most days, essentially, got a nice consolidation. Well, not a nice consolidation, but Asian consolidation here. And as soon as London opens around 7 a.m., we do have that move to the downside, move to the upside during the New York session. So at 2:30, when New York trading opens, well, from 1:30, we see that purge of liquidity. So that impact of liquidity in the markets, we do see it coming, and markets does have these strong moves either side. So that's really when we do see these active traders and these big moves in the markets happen the most. That's not to say if you don't trade these hours, you're not going to be profitable, because there will be patterns on the 4 hour and the 1 hour that you'll be able to exploit. In understanding market structure videos, I talked about how we recognize temporal disposition, and I went through the 4 hour chart and I showed you examples on a 4 hour chart. So if you come home at 6-7 p.m. and you spot these patterns happen in the markets, you can set orders in the market and set different alerts where you're able to enter these trades on these high time frames. But it is really important that you recognize what time frames will suit you, really, and you will have to use your discretion to pinpoint, find the most suitable time frames for you to actually work around. And as I said before, you just don't copy our trades, because you won't learn anything to start off with. And the second piece of advice, and something you should consider, is what actual time frames you're going to look at. So we do stress the importance of high time frame bias. So it could be, for me personally, so I'm most active on the M1 and the M5 time frames, but my high time frame bias will always come from the 4 hour or the daily. I look at the daily every single day and throughout the day as well, just to figure out where the longer term trend is. However, to enter the trades and manage trades, I use the 1 minute, 5 minutes. So you see there's a big difference in time wise between the time frames, but that's something that works for me. So I will suggest, let's say, if you do trade the hourly, you look at the 4 hour or the 8 hour potentially, and the daily candles, just so you have that view of the market as a whole and the bigger trends establishing, because you really don't want to be trading. I'm not saying it's not going to work, but you want to align your high time frame bias with your lower time frame bias, because it will give you those extended moves, those big moves to the upside. Just as an example, let's say you are trading the 4 hour and you're trading the daily as well. So if I just use the replay tool here, just to pinpoint my example, daily. So on the daily time frame, you might be looking at, okay, so the market has now made a new low and a lower high as well. So what I'm looking for is potentially the market to push even lower, or just kind of stay here and shoot for these highs again. So my daily bias isn't clear. However, looking at this specifically, I feel like this candle here, I know it's not quite a bullish engulfing. It is a very strong candle indicating there might be a move to the upside. So if I go on my lower time frames, what am I seeing here? So this is the lower highlighted and this is the high. And if I look at the market come down here, what can I see happen in the lower time frame? So what I talked about with the temporal disposition pattern is we had a low made the market here, we have a lower low, we had a lower high, and the market just started to trend downwards here. I'm just going to mark out the lows and the highs, as you can see. So you got lower high, lower high, lower high, lower low, lower low, lower low, and lower low. And what does the market do after that? So the market comes in and actually closes past this lower high here, which indicates to us that's the first sign that the market's going to reverse. So me looking at this market now, I'm a 4 hour trader. So this is 10 a.m. So I might not see this candle because I am working. And so let's say I come home and this is what the market's presented to me. So that's 4 o'clock. That's the 6 o'clock candle. So I'll come home just after 6 o'clock, and I see the market trading around here. As it's the 4 hour candle, let's say it's about 7, 8 o'clock, and the market's just trading around this line there. I'm going to that, I didn't even mean to. leave that line in. But yeah, let's say the market's trading around there. So now, I now have come home. What I have seen this pattern form, and this is the first sign of reversal. So what we know is the market will likely to come back, and actually when it comes back within this area here, we're going to be looking for our entries. So you might want to enter the market somewhere around here, let's say, with your stop below the low, and you're going to want to target this high here, or maybe this high, whatever strategy that suits you essentially. So as the market comes into here, what you're going to be looking for is you're going to leave that order in. So you're going to have a 67 pip stop and a 101 pip target on this trade specifically, which is 1.5R. It doesn't mean because you're targeting more pips, you're less likely to win that trade. These, like, the whole point of this temporal disposition pattern is price action does the same thing on different time frames, whatever time frames you trade. Obviously, if I'm trading the 1 minute, I'm going to be looking for shorter pip movements because I'm going to have smaller stops. But if you have bigger stops, you are able to look for those bigger movements in the market because your margin of error is bigger. So that doesn't mean your strike rate is going to be less than mine, or vice versa. You can both make money in this market. It's just adapting yourself to actually trade the market rather than the market trading you. And as cliche as that sounds, you do need to adapt your personality to the market. You can't just be out there copying everyone else's trade. So yeah, as the market comes down here, I might want to bang my order in with the stop below here, and then see, do you get stopped out? Not sure. Market does come low. What it comes low on the 8th of July, but it doesn't actually stop you out here. And yeah, and then it actually goes to target. So you would have got squeezed on this trade for about 3 days. But if it's in your plan that you don't exit the trade until it hits stop, then you would have still been in this trade. Maybe you would have exited this trade based on some based on some pre-exit criteria you've had in the market, which we're going to talk about later anyway. But just for the point of the demonstration, I just want to show you guys that I'm stressing that you do trade the time frames that suit you, rather than obviously copying everyone else's trades. Even though I trade sometimes we might have the same trades anyway if you are looking at the same time frame. So what we don't want is you just copying every single trade that we do, because as I said, just not going to learn anything. And my main point of it is that you actually learn to understand market structure and understand where the market is going itself.